Looking ahead, what are the emerging trends or potential legal changes that could affect the securities compliance in private funds or syndications? What do you see?
Yeah, well, the biggest change that's likely coming soon in securities law is the change of the accredited investor definition, right? So right now, when it comes to the economic tests for accredited investors, there's really the two primary. It's the net worth test, which is if you have $1 million of net worth excluding your primary residence, or it's the income test, which is, hey, I have $200,000 in annual income for the last 2 years in a row, and I reasonably believe I'll make that again this year. Or if I'm married and filing jointly, then it's 300,000. Those are the two primary economic tests for accredited investor definitions right now.
This is the Real Estate Wife Show, and I'm your host, Loomba. As a real estate investor and fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. Today, I have my very good friend, Adnan Merchant, with me. Welcome, Adnan, to the Real Estate Wife Show.
Thank you, Vinky. It's a pleasure to be here. Thanks for having us on.
Of course. A little bit about Adnan. He's a distinguished corporate business and private securities attorney and a co-founder of MW Law. Since launching the firm in 2017, he has played a pivotal role in facilitating billions investment transactions across private equity funds, real estate syndications, and venture capital. His practice is dedicated to providing comprehensive legal services, including structuring private investment funds, maintaining securities compliance, and managing investment transactions. Recognized for his expertise, Adnan has been honored as one of the D Magazine's best lawyers under 40 in private equity space for 4 consecutive years from 2021 to 2024. Wow, I have a celebrity guest today. Congratulations for that.
Thank you. I appreciate it.
Today, we'll uncover the layers of legal considerations that shape the private equity, venture capital, and real estate sectors, exploring how changes in securities law influence investment strategies and compliance. We'll also discuss the growing trends in the fund structures, including special purpose vehicle, SPVs, and fund of funds. Today, our topic is navigating the nuances, the evolution of securities compliance in private investment. So can you provide us with a brief overview of what security compliance entails for private investment funds, Adnan?
Sure, yeah. So sort of as a 101 and kind of just taking a step back, right? The short version is when you're raising equity capital from private investors who intend to be passive investors with you, the SEC regulates those transactions. What we call those transactions are sales of securities. And securities can be anything like stock in a company, interests in a fund, LLC interests, partnership interests. When you sell those things to investors, which is what you do when you raise private capital, you are selling securities, and securities are subject to compliance, which is where we get securities compliance from. So the Securities and Exchange Commission regulates those transactions and basically puts forth a bunch of rules that we have to follow in order to be able to do those things. It's rules meant to protect the public from fraud. It's rules meant to ensure transparency in investments and things of that nature.
So, but it's tied to real estate, right? So
a lot of it is, yes. So especially when you're raising funds and passive investment vehicles for investments into real estate, there are certainly a number of laws that apply to it, a number of compliance mechanisms that apply to it, and including, of course, most especially the one that most people are familiar with is Regulation D, which governs that actual investment transaction, but also the Investment Company Act, which governs the fund itself, given that it's an investment company. But if it's invested in real estate, then there's a special exemption in place for having to register it as an investment company that we call the 3C5 exemption. Happy to get into details on any of those if you'd like.
yeah, sure. I would love to hear that, your perspective on that, because people are doing different stuff days, especially into 506C and 506B. And there's a new thing came out now. People started doing 506B and then they pivot to 506C later on, right? So if you can share
Right.
some light on that, how does that work? Is there any cool-off period in the middle or just like
Yeah, sure. Absolutely. Most happy to do so, right? So a couple of, I think a little over a year, maybe 2 years ago now, the SEC kind of loosened some of the restrictions on what we call integration. And so just taking a quick back step so that all of your listeners are also on the same page. When we talk about private investment transactions and specifically even in real estate, there are actually four securities laws we should be cognizant of at all times. The Securities Act and Regulation D is just one of those, right? And that just governs a transaction of the investment to and from the investor. But as I mentioned, another one is the actual Investment Company Act, which governs that fund or syndication vehicle itself. Another is the Investment Advisors Act, which might, in certain instances, govern and have additional requirements on the general partner or the sponsor. And then lastly, there's also the Exchange Act, which governs broker-dealer issues, which is something that everyone should always be cognizant of, especially in the space in which people are raising money for other people or for other people's deals and things like that. But to back up to your specific question, then we go back to Regulation D in the Securities Act. And Regulation D has a number of exemptions. The two most common are 506B and 506C. Generally speaking, these are two different rules, and each of them have their own set of compliance mechanisms that if you follow them, they're what we call a safe harbor when conducting securities transactions. And basically, that just means, look, if you're going to follow all the rules under 506B or 506C, we're going to give you the assumption that you are in compliance with securities laws. And that's why we call it a safe harbor. So those basically the way you should think about them is they're two different rules. Kind of pick one and decide which one you want to go with. But as I mentioned, about a year or 2 years ago, I forget exactly when, what the SEC used to do prior to this was, look, if you had two offerings on the same entity and they were basically about the same, the SEC would integrate those and consider it a single offering. And that could be bad for a lot of people that were trying to do one or the other, given general solicitation rules or taking of non-accredited investors, which were separate and distinct based on the one you chose. Now the SEC has loosened some of those restrictions, which does allow you to go, for example, from a 506B raise and then into a 506C raise thereafter, right? So again, as a refresher, the 506B does not permit any general advertising for your offering, right? It must be pre-existing substantive relationships that you solicit for your offering. In exchange, the SEC does allow you to take up to 35 non-accredited but sophisticated investors. So what a lot of people have wanted to do and what they can do is they can start as a 506B offering, conduct no general advertising and conduct no general solicitation, but at some point they can terminate that offering, open up a new subsequent offering on the same investment vehicle. This time it's a 506C, and now you're out there generally advertising and doing all of those things. But there are some important rules that come with that integration, right? While it's not expressly required, we do recommend now about a certain amount of cooling off period. Again, there used to be a bright line for that. There's not so much anymore with the new rules, but we do still recommend some period of bright line because the actual requirement is to show that you have in fact fully terminated that original offering. That means no more selling, no more advertising. As far as anyone is concerned, that offering must actually be terminated, right? So some of the best ways to show that is to in fact have a bit of a cooling off period where you say, look, the investments are closed. We're not accepting any more investments. The offering is closed, right? And then you can come back and launch a brand new offering that is now a C. One other thing that we do recommend when we do integrated offerings like this, or rather non-integrated offerings like this, is that we do require, or rather we recommend the establishment of brand new share classes under the new offering. So in other words, you're offering a whole new set of securities under the new offering that you weren't offering in the original offering. And that's just to, again, continue to differentiate how these are two separate investment offerings. We're not giving you the same stuff in the old one that we are in the new one, right? So that has become a new common trend that people have started to do in the last year to 2 years because those restrictions have lessened up, and it does tend to help, depending on kind of what your goals are for a raise like that, right?
Great. And then you were talking about Advisors Act. What is that? Can you share that as well?
Yeah, so I think in the context of these additional securities laws, I think one of the conversations that is easy to have as an example is fund-to-fund offerings, right? So as I'm sure you know, and we talked about this just before this as well, one of the other trends that's really picked up are fund-to-funds, right? A lot of people these days, that is something that they're very interested in wanting to pursue or at least learn more about. And quite simply put, what is a fund of funds, right? Well, it's where you raise a fund or a syndication, but instead of being the actual operator of that real estate or actually purchasing that real estate, your fund is investing in another fund, right? So you are raising your own fund to now go and invest in somebody else's deal and somebody else's syndication. So as I mentioned, typically people tend to think about just the Securities Act and Regulation D, and they forget about these other three acts, right? And the other three securities laws are always applicable. They might just have exemptions that exempt you from those things, right? So let's kind of start with the next one in line, which is first the Investment Company Act, right? So a regular real estate syndication, that is to say, a deal that you put together or a fund that you put together to acquire actual real estate assets is going to be exempt from the Investment Company Act by way of an exemption that we call the 3C5 exemption. Basically, all it says is, hey, look, yes, we would be an investment company according to the SEC's definition, except that what we're really buying and investing in is real estate and not securities, right? So this is not a venture capital fund or a traditional private equity fund. We're not investing in securities. So we really shouldn't be subject to the requirements of the Investment Company Act, right? And so as a result, the SEC has given us that exemption under 3C5 that says, look, if your investment company is in the business of real estate investments, then great, don't even worry about it. You are exempt under this exemption. But a fund of funds, for example, now, right? Think about again what a fund of funds is doing. A fund of funds is not investing in real estate. Instead, a fund of funds is investing in the securities of another fund. So now you are subject to the Investment Company Act, right? Fortunately, there are additional exemptions under the Investment Company Act that kind of get you through some of those. The most common one that you would rely on, which is the one that most other traditional private equity companies would rely on, would be the 3C1 exemption, which is basically the small private company exemption. And basically to fit that definition, you need to have fewer than 100 beneficial owners. So if your fund is limited to less than 100 or fewer than 100 beneficial owners, you can qualify under this exemption and also don't have to register as a registered investment company, right? So that is very important. That's one of the first limitations that fund of funds have that regular real estate funds and syndications do not have, right? Be wary of that. Understand that you are not the same as a real estate fund when you do a fund of funds, right? The third one then is the Investment Advisors Act. So that's the one that you specifically asked for under this conversation. And where that comes in, quite simply put, is with respect to the general partner of this fund of funds, right? So again, if you're an actual investment company or if you're exempt as a 3C1 investment company, it means, what are we investing in again, right? So if we're investing in securities, if we're investing in other things, then the SEC wants to know, well, who's qualified to be giving this fund advice on an investment in securities, right? So who's the qualified investment advisor that is advising this fund, right? So that's where we get the Investment Advisors Act for. So oftentimes when you're structured as a traditional private equity fund, a venture capital fund, you do have a requirement to either have a registered investment advisor advising the fund or an exempt reporting advisor also engaged to provide advice to that fund, right? Now, there are different thresholds for exempt versus registered, and we can go into that in greater detail at a later time, but it's sufficient for now for you people to know, and especially your listeners to know, this is why fund of funds sometimes are not as straightforward as everyone thinks they are, right? Because now not only are you invested in securities, so you're a 3C1 fund, but now the SEC is going to be asking, okay, well, do we need an investment advisor here? Is there somebody that needs to be advising this fund of funds on these investments? There is some debate about this issue, so I will be honest and upfront about that. There are some instances in which if you're doing a one-off fund of funds, that is to say your fund of funds is also a syndication for a single downstream investment opportunity, maybe you don't need an investment advisor, right? Maybe you are still a 3C1 fund. There's no way around that. But maybe we can get away with saying, look, there is actually no advising on securities happening. We are simply a management conduit for an investment into another real estate investment, and we might not need it, right? But there's no instance in which if you raise a blind pool fund of funds with the intent of investing in multiple additional downstream investment opportunities, that you now don't need an investment advisor because now you're invested in blind securities. There must be somebody advising the fund properly on what a good investment in those securities are. The short answer here is it sometimes just depends, right? And the honest answer is you need to speak to a securities lawyer before you engage in a fund of funds and to determine if you need to meet these requirements and if you need to have these filings or engage investment advisors and things of that nature. So that's sort of the landscape when it comes to fund of funds and these additional securities acts, right? And people tend to sometimes forget about them, but they are important. They all apply, and you need to be cautious when you're doing fund of funds with respect to this kind of a securities landscape, right?
So what if you have a 3C5 fund and then you're investing in others deals? Not necessarily you're investing in real estate, but it's a real estate deal, but you're still buying the securities. So are there any implications there, or do you need to have this ERA or the Advisory Act applicable there or no?
So it's a good question, and what it requires us to do is go back to 3C5. So what actually qualifies an investment company to get that exemption? There is a tiered structure for sure, but for ease, when what we like to tell our clients is don't worry about the tier structure, just have the number 80% in mind. So 80% of the fund's assets must be either real estate or mortgage-backed instruments in real estate. In other words, you've given a debt, but that debt is secured by actual real estate, such that if that note went into default, the fund could exercise a security interest in that deed of trust, in that mortgage instrument, and actually own real estate. So if 80% or more of the fund's assets are real estate, you qualify for the 3C5 exemption, and we don't need to worry about the investment advisory piece on that, right? But if
But
at any point,
investing in others deals, not necessarily
right, so it's the 80-20
buying it
test,
yourself.
right? So
It's still
80% must not be in other people's deals. 80% of your fund must be actual real estate or mortgage instrument assets, right? So the other
for
20% of your
yourself.
fund, right,
Like
it could be
you have to be on the acquisition side, 80% yourself,
correct.
and
Another
20% you can invest
actual
it.
real estate. Yeah, right. So I've got a syndication and I'm buying the apartment complex with my syndication, right? With my fund, right? So the asset of my fund is not securities in someone else's deal. It is actually that real estate, right? It is actually that building, right? So that's what qualifies us for 3C5. And that is the operative term before we look at the investment advisor pieces, right? The short summary is 3C5 requires an active controlling interest in real estate for at least 80% of the fund's assets under management, right? 20% could ostensibly be in other types of investments, subject to then maybe additional securities issues. But for the 3C5 exemption, 80% of the fund's AUM really should be in controlling real estate.
And then you need to be part of the general partnership team if you have that fund,
That's a
because
factor. Yeah, that's one of the
you have a
factors.
substantial role,
Right. So that goes to that control piece, like we talked about, right? So are you actually controlling real estate? Now, the honest answer is even there, it really depends, right? If you're 2% on the GP side, do you really have a controlling interest in this real estate? Maybe not, right? So will that allow us to rely on the 3C5 exemption for your fund? Maybe not. It is case by case. We have to evaluate a multitude of factors when we make these determinations. So again, always be speaking to a securities attorney before you deploy those kinds of assets and those kinds of funds, right?
So since we're talking about funds, let's talk about the customizable funds as well, because
Sure.
that's like really a lot of fund of fund models. They are doing the customizable funds, basically having multiple SPVs under one umbrella. So what do you think about that? And what are the implications? What if one deal goes
Yeah.
wrong? How
Yeah.
the fund is protected? Like it's like not the whole fund is gonna suffer,
Right.
regardless of how many investors are in each deal.
Yeah, absolutely. And I'm very glad that you brought that up, right? So this customizable fund, we have our own version of it that's proprietary to us at MW Law. We call it the Flex Fund, right? And the Flex Fund, quite simply put, what it is that it's a single fund, but it allows investors to diligence each of the deals underneath the fund through an SPV. And so as a result, it removes the blind component of the fund. It is no longer a blind fund. Investors get to opt in and choose which deals of the sponsor they specifically want to be invested in, while at the same time it's a single fund. So it is a very powerful tool. It is a very powerful model. It's not right for everybody, but certainly for those for whom it is right for, it can be a very powerful fund model. There are a lot of nuances to it. There's a lot of kind of complexity to it. And so it's not something that should be done lightly or easily. I'm going to be completely honest. To your points, right? The Flex Fund, if not done correctly, opens up the fund to cross-collateral liabilities, opens up the fund to an unshare distribution of organizational expenses. There's a whole lot of things that if it's not done correctly and structured by proper securities lawyers can be an issue, right? So as a result, I'm going to be completely honest. Our Flex Fund is not meant to be a cheap or a quick product, right? It is a highly nuanced and sophisticated fund model that we reserve for people that know how to deploy it or that are interested in deploying it in the right way. So when we build a flex fund, there's a huge educational component that needs to come with it, right? Because it's not a traditional blind pool discretionary fund, and it is not a simple syndication, right? So we take the time to really educate people on that because there's a lot of different components to be weary of and make sure that it meets your goals. Again, it's not right for everybody, but again, for those for whom it might be right for, it can really, really work, right? So a couple of those nuances are like, look, we talked about it's a single fund, which means you have a single offering. So it's a 506B or it's a 506C for the whole offering, regardless of the number of SPVs we put under the deal, right? But each deal can be unique, right? Each deal can, maybe the deal one is an 80-20 split. Maybe the second one is a 70-30 split with a 6% pref, right? So the beauty of the model is absolutely it allows you to custom tailor specific deals and allow investors to pick and choose those deals. But again, it has to be done so cautiously and properly. There's a lot of pitfalls if not structured correctly.
So in your model, can you structure the deals 506C and B under the same umbrella?
No, so that's what I was talking about earlier. Well, okay, so back up a second because I'm a real nerd about this, and my teammates in my firm are real nerdy about this. There is a way. The short answer is there's potentially a way to do that. But that's less of a flex fund and more of what we call a pledge fund. And a pledge fund is another really cool model that we actually borrow from venture capital, right? So this is from my days when I was in venture capital. And it's a type of model that is still blind pool-ish and does allow multiple different offerings underneath the same type of fund, right? But it is a little bit different than a flex fund. But our firm specializes in the creative, in the unique, and in the customizable, right? So certainly for a couple of clients, we have melded those two models and we have created a unique and custom solution that meets a lot of different goals. Now that's getting really into the weeds, so I don't want to get too far into that. But the short answer is it's possible. It's just not always recommended, right? And the traditional, or the standard flex fund rather that we have, that is not the case. The standard flex fund, look, it's a single fund. So there is a single evergreen open offering at the top, right? It's not a deal by deal offering so much as it is a single offering at the fund level and then specific class packages for different deals that you invest in underneath, right? So again, I hate to keep coming back to this, but the short version is talk to an attorney, and a securities attorney specifically, and folks like us would be able to take you through some of those very nuanced and novel ways to do business.
So earlier you were talking about with the fund model, you mentioned something really interesting. You said it's not a traditional syndication model and it's not a blind pool fund model either. It's something kind of in the middle, the flex funds or the
Right.
customized funds, right? So it's not necessarily raising at the deal level or you're just raising as a for the blind pool fund. So if you said there's a lot of education, so share with us, what are you educating
Sure.
your investors or the fund managers, how to manage or mitigate this gap between the two
Yeah.
scenarios?
Yeah, a very good question, right? So at the top level, as I mentioned, it's an evergreen offering, which means the offering on the fund itself is perpetually open, right? It's an open-ended offering. It is not a closed offering, right? But you are still able to raise on the deal by deal level. So as you have a new deal, what we do is we set up a new SPV, right? Which just stands for single purpose vehicle or sometimes special purpose vehicle. Basically, all it is it's a wholly owned subsidiary of the fund, and we house the new investment in that SPV. Then what we do is we open it up to say, hey, okay, so whoever would like to be in this deal is going to get what we call hyper target allocations of profits and losses specifically from this deal and this deal only. So you are still raising on a deal by deal level, right? And what we would do is every time we do a new deal, in addition to opening up that SPV, we deliver what we call a class issuance package. It's a short form PPM, basically, that says, hey, this is 123 Main Street, our new deal. These are the terms of 123 Main Street. It'll be an 80-20 split with a 6% pref and 2% asset management fees or whatever we might doing. And the current investors in the fund or the current participants in the fund and, others that we're marketing to, 15 days, 30 days, opt in if you'd like. This is the allocation, right? So people are able to come in and opt into that specific deal under the fund. Once they've joined the fund overall and signed the subscription documents and the PPM has been reviewed, and those things, they're in the fund. And now all they need to do is acquire additional securities specifically of that investment, right? So from a technical standpoint, it's a single fund, which is great, which means your investors at the end of the year get a single K1. Even if they're invested in 10 different deals of yours, they're not 10 separate deals anymore. They're all under a single fund. So it's great as an investor to have kind of a centralized situation. And it's great for an operator and a sponsor to be able to centralize it. But it's also gives investors the ability to diligence each deal and decide if they like a deal or they don't like a deal. And they get to come in on whichever the ones that they do like or they appreciate, right?
Mhm. Thank you for sharing that. So since you mentioned PPM, let's talk about PPM. For the
Sure.
investors who may be new to this concept, PPM stands for Private Placement Memorandum.
Right.
So why is it essential document, I would say, for private placement or the private investments? And since you have thrown multiple acronyms there, SPV, PPM, do you need multiple PPMs in flex funds or just one PPM? And then you can do deal disclosure at the deal level. So if you can talk about that a little bit.
Yeah, absolutely right. So the private placement memorandum or the PPM is an essential document that we cannot recommend enough when you do private investments, right? As a reminder, when you do these private investments, part of those securities compliance rules that we talked about earlier involve disclosures, right? Involve specific disclosures about the nature of the deal, potential risks involved with the deal, parameters, disclosures of conflicts of interests, fees that the general partner might be taking, right? So all of those things need to be disclosed. And the PPM is just one of those super convenient documents in which to provide those disclosures. It's industry standard and practice for a reason because it is just the best way to deliver those disclosures. So as a sponsor, it protects you because you've made those disclosures. As an investor, it is critical that you request a PPM so that you can understand what the components of this deal are, what the risks are, and so you can evaluate the merits of a deal and decide if you want to invest in this deal or not, right? So that's what the PPM is overall. And that's one of those things that we build for every single investment deal that we do for our clients. It is highly recommended and it is the best way to protect both sides of an investment transaction. In the flex fund, the PPM is a single PPM at the fund level, which is great, right? So it's going to be effectively a pretty broad scope PPM that says, look, this is what a flex fund is. This is how it operates. Every time we have a deal, we will issue what we call a deal disclosure or rather a class issuance package that does give you short form disclosures about that deal specifically. And so, yes, so in the flex fund, while it's a single overall broad spectrum PPM, we do still provide what we affectionately call mini PPMs every time you have a deal, because again, that's the purpose, right? Is we're going to disclose the deal, we're going to disclose the risks, we're going to disclose what we're doing with this deal, and now investors can evaluate each of these deals and decide if they want to come in or not.
So what are some of the rights or protections do investors typically have when investing in this private placements? And how can they ensure that these are adequately addressed in the memorandum? Because a lot of people, when they go through the PPM, they have tons of questions. They'll come back and they have heard these terminologies like clawback or something like that, why
Sure.
this thing is missing or why this thing is not there. How do you address all those? I mean, is it required for PPM or is it not so much required, but it's just like kind of case per case basis? So if you can talk about that a little bit as well.
Yeah, absolutely. I think to answer kind of a more broad question here, right? When you're an investor investing in a private investment offering under Regulation D, typically speaking, in an investment fund or in a syndication, investors really don't have any rights to participate, right? Especially in the day-to-day or even the major decisions. Investors need to be concerned typically with three things. The first is their economic rights, right? And those are going to be governed by the waterfall or the distribution that says, hey, this is how we're going to split profits between us, the investors, and you, the GP, right? This is how we're going to do it, right? So economic interest is the first place they should be looking at, and determining if those economic structures and rights match up with what they're being told their projections on an investment might be. The second is transfer rights, right? So, hey, look, Am I going to be allowed to make any transfers here? Am I going to be allowed to do an affiliate transfer for estate planning purposes? Can I sell my shares to a third party? What are all of those about? Now, what I will tell you is don't forget shares that are, securities that have been sold under a private placement are restricted securities and cannot be sold for a minimum of 12 months after issuance to a third party. So there are no resales for a minimum of 12 months, but more than that, in most deals, most sponsors will still further limit that, and they have the right to do so. So even after 12 months, you might still not be allowed to sell to a third party without the consent of the general partner, right? So that's something to keep in mind. But most general partners will permit some level of transfers for estate planning purposes. So let's say you sign an investment as an individual, but tomorrow you'd like to move the investment to your trust that you are the beneficiary of and that you control, or you have a trustee that controls it. Most of the time, they're going to be okay with some of those things, but just pay attention to what that is on a deal by deal basis. And then the third is governance rights overall, right? So again, as I mentioned, in a syndication or a fund, there's really no governance rights, right? You're not going to have the ability to participate. You are a passive economic rider, which is part of what the PPM should be properly disclosing to you. And so typically what we tell our clients is, look, at the end of the day, set aside everything else and really pay attention to this one thing. You should not invest in a deal in which you don't implicitly trust the sponsor's team, because you will not have a participation right to guide the destiny of the outcome of the project. You will be entrusting the sponsor team to carry out their project plan. And if they don't do so correctly, you don't have any recourse on that necessarily, right? Absent fiduciary duty violations and other things like that. But the point simply is investors should always be aware that as passive investors, that is truly what they will be, passive, right? There won't be any voting instances with the exception of removing general partners for fraud, or if there's votes to change the economic structure, right? That is adversely impacting investors. Generally, in most of those cases, also investors vote, but that's it. There's no other participation right.
Wow, interesting. Maybe we should have another episode on just on PPM, what should look for from investor perspective as well as from the syndicator perspective, we should
Yeah,
have that
sure.
episode on that when you have
Yeah.
time. But for now, I wanted to ask you this, looking ahead, what are the emerging trends or potential legal changes that could affect the securities compliance in private funds or syndications? What do you see?
Yeah, well, the biggest change that's likely coming soon in securities law is the change of the accredited investor definition, right? So right now, when it comes to the economic tests for accredited investors, there's really the two primary. It's the net worth test, which is if you have $1 million of net worth excluding your primary residence, or it's the income test, which is, hey, I have $200,000 in annual income for the last 2 years in a row, and I reasonably believe I'll make that again this year. Or if I'm married and filing jointly, then it's 300,000. Those are the two primary economic tests for accredited investor definitions right now. But those definitions came out way, way long ago and have not been adjusted for inflation. And so both Congress and the SEC have been mulling over and toying with adjusting that definition to match with inflation. And most securities attorneys are of the opinion that it's definitely happening, and also that it's likely going to be to the tune of raising the threshold for the net worth from $1 million to about 3.2 million, something in that range, because that's about what it would be adjusted for inflation since the last time the definition was actually updated. So I think the biggest impact that that's going to have, of course, is it's going to dramatically reduce access to capital in private placement economics, right? However, to offset that, or at least with the intention of offsetting that, the SEC is also mulling over providing a new avenue with which to become an accredited investor. And that quite simply is going to be to take a test. So they're going to put forth a test that, look, you study for it, you pass it, you will be considered an accredited investor, right? So that's going to be one thing that they'll probably release alongside that. Why all of these things happen and why they're important is a question that I get a lot, right? Because there's very strong opinions on kind of both sides of this debate, right, as to whether they should or they shouldn't. But what I would encourage people to do is go back and really think about what the remit of the SEC is, even to begin with. What's their mandate, right? The SEC's entire mandate is to protect the public from fraud, right? And so as a result, and to help do that, because they don't have unlimited resources, they have created these stratifications of investor capabilities and investor net worth, from qualified purchasers to qualified clients to accredited investors and so on, right? And so it's a sliding scale where they're like, look, people that are on the higher end of this scale we have the presumption that they can take care of themselves, and that if they were to lose an investment, they would not, lose everything, right? Down to non-accredited investors who deserve the SEC's utmost protections, right? And so as a result, those numbers, if we're going to be basing that based on income and net worth, probably should be adjusted for inflation to some degree to help protect in that sense. So that's the theory behind where the SEC and Congress are coming from on these things, right? Of course, economic impacts notwithstanding, right?
Yeah, but then they're making it easier too to take the exam, and then you could be, sophisticated, and that puts you in the category anyways. So I don't know. I mean, passing the exam shouldn't be that hard for a lot of people because
Yeah, well, we don't know
a
what
lot
the
of
exam
people
looks
saying
like,
that too. Yeah.
unfortunately. Yeah,
Yeah,
no idea what
exactly.
that's going to
So,
be.
yeah, so I'm not sure if it's like really solving a problem or it's not a problem at all. But this brings us to kind of towards our end because we are way over time, and I love chatting with you. I would love to have you back, and I wanted to explore this whole world of the PPM with you a
Sure.
little bit further. And at this point, can you share one golden nugget with my audience?
A golden nugget. Hmm. Golden nugget. Well, let's bring it back to sort of some of the fund of funds pieces real quick again, right? Because a big part of what people do fund of funds for is so that they can invest in other deals. But when they do so, they're doing so with an expectation to become part of the co-GP team for some of these additional deals. And I want to bring us back to the fourth securities law that I kind of very only mentioned but didn't go into, which is the Exchange Act. And the
Mhm.
Exchange Act governs broker-dealer issues, right? And just to be super clear about this and to put it in as simple terms as possible, it is highly illegal to compensate somebody that is not a registered broker dealer for soliciting capital on behalf of somebody else, right? And that compensation is what we refer to as transaction-based compensation. That is to say, quite simply, as an example, if you raise 5% of this raise, I'll give you 5% of the co-GP, or I'll give you $5,000, or I'll give you a super expensive bottle of wine or something like that. All of those things are transaction-based compensation, right? I raised capital for you. I'm getting compensated in return, right? So the nature of that transaction-based compensation is very, very scrutinized and falls under the Exchange Act and is governed by broker-dealer laws and regulations. So a lot of times when people are doing fund of funds these days, they're doing it with a view to get compensated, right? To become a member of to become a co-GP on somebody else's deal. And I just want to always encourage people to be very, very careful about those kinds of arrangements. You should only be a co-GP if you're actually a bona fide co-GP. In other words, your job is not raising capital. That's not why you're getting co-GP interests. You are, in fact, a bona fide co-GP. You're going to have substantive duties, substantive services. You're going to be assisting the other partners, doing the diligence or helping with the tax returns or walking the properties, or some sort of material service for which you're getting compensated. Because what will happen, and what will start to happen more and more, is that FINRA is really going to crack down on unregistered broker-dealer activities, right? They announced that as one of their enforcement initiatives back in January. It's going to be one of the things that they're going to really be coming after now, because too many people are doing that in an unregistered way. Too many people are taking advantage and not properly following those laws. So if it's a golden nugget, my golden nugget is to please stay out of jail when you do some of these things, right? And to please come and talk to an attorney. There are finder's exemptions. There are other ways in which we could potentially look at structuring some of those instances, but you must talk to a securities attorney before you just kind of make those deals and make those determinations, because you could very easily end up accidentally violating broker-dealer laws.
Thank you so much. And this brings us to a rapid fire round. I'm going to ask you 5 questions, and you're going to answer in one word or one sentence only, not two, just one.
Okay. All right, let's try it.
Are you ready?
Yeah.
Okay. So, what is one of the most important thing that you have learned in your life, and how did your life change after learning it?
Loyalty. Just being loyal with people and just making sure that you give back what you're also getting. That's a principle I've lived with for a very, very long time. When I was a kid, I made a mistake and learned from it very deeply, and that's something I've carried on into adulthood, and it served me very, very well.
Love it. Share one good book that you like and like to recommend to my audience.
Ooh, I'm a real science fiction nerd, so I'm going to recommend the Expanse novels by James S. Corey. It's a fantastic series of books. It's
Mhm.
also a show on Amazon Prime, but I highly encourage everyone to read the book because it has every life lesson from loyalty to courage to bravery to doing the right thing to tilting at windmills and those kinds of things. So I highly recommend it.
Nice. So, what is the show name?
The Expanse.
The Expanse as well?
Yeah, yeah. If you're looking for a non-fiction option, then I would recommend How to Live Like a Roman Emperor. It's a book on Stoicism and applying Stoicism specifically to cognitive behavioral therapy. And so for people that are interested in that, that's a fantastic place to start.
Great. In one word, what does life mean to you?
Happiness.
Good one.
Yeah.
What is your biggest passion?
My biggest passion is probably my business right now. I enjoy working what I do. I enjoy building what I'm building. I enjoy the daily challenges. I enjoy the life that we live and the things that we do.
So it doesn't feel like work, right? Because you
Yeah,
love it.
exactly. Yeah. Now,
If you
that said, I have a 9-month-old daughter at home, so you can ask her again.
could, don't miss out on that because they grow
Oh
so
no.
fast, I can tell
Yeah.
you.
Oh yeah. Absolutely.
So if you could turn back in time and talk to your younger self, what would you tell yourself and why?
I would tell myself to keep going. I think I had a lot of doubts in my early adulthood, as I was either becoming a lawyer or planning to become a lawyer. I just wasn't sure if it was what I wanted to do. And now fast forward to where I am, and I'm very lucky that I was encouraged to keep going and to be here. And so if I were to go back, I would tell myself to just keep doing it and stick to the plan. And it's a good plan with a good outcome.
Yeah, trust the process. That's
Yeah.
good. So
Yeah.
how can people reach out to you?
Email is usually the best way. So my email is just Adnan at mwfirm.com. And they can send us an email and we're more than happy to help with anything that we have.
Thanks, Adnan. I really enjoyed our conversation today.
Likewise, as always, it's a pleasure to be on. Thanks for having me.